to make the right financial decisions. Turn your radio on and listen to Give and John. It's your money and your money matters. It's your money and your money matters.
Hi, this is John Hardy.
And I'm Gib McEachran. Welcome to our mid-year review and outlook for the rest of the year from HMC Partners.
We've had quite a first half of the year, haven't we?
We really have, and I think the second half probably looks like we're going to have some ups and downs too.
But have we had a year so far that has surprised you?
Yes, it has surprised me in that I think we're further along as far as rate of return, if you just look at the S&P, than we would be. We're having a lot of the same repeats from last year. You talked about Europe, geopolitical issues. We seem to, as a market, our markets seem to be handling it a lot better than they did last year.
I've been impressed of how the market has seemed to be resilient. We've had the volatility that we said we would at the first of the year through July this year. That's not anything different. We knew we were going to have that. And we've had downturns that we expected also. But in the total picture where we are, the market seems resilient. It wants to move forward. It has a lot of headwinds that push against it. And like any boat that's on a course, we have to make corrections and track this way to get to where we ultimately want to go. But I have been pleased with the underlying strength of the economy thus far.
If you look at portfolios, our portfolios look remarkably like they did last year.
Mm-hmm.
I mean, I think that they're portfolios that have a lot of large cap value and a lot of intermediate to long-term bonds, and those are sort of safe haven places that we've kind of camped out in over the last year, and I think that would be a place that we would look to be remaining the rest of the year with some tweaks along the way.
I think you're right. The large company stocks that provide a dividend stream continues to provide a solid return within the portfolio. Our bond side, we've tweaked that who knows how many times, but it's now, my observation, I'm sure yours, is that it's balanced, it's providing strong earnings. We don't have in this market a lot of volatility in it. In fact, we're actually picking up some capital appreciation in it.
Yep.
We see that going forward into the second half of this year.
So what we've seen, I think we've seen kind of slow to now no growth, which is a little bit of a headwind. We've seen job creation start to slow down. We had great corporate earnings in the first quarter of the year. I think we're kind of going to have mixed earnings in this particular, at least it seems to be mixed earnings in our earnings season right now, and then we're headed towards the election, and we can probably talk about that after we hear from Jeffrey Kleintop. And we're going to pause here and have Jeffrey Kleintop, who's the Chief Market Strategist for LPL. And when you receive our weeklies, a lot of the information that we provide in our weeklies does come from Jeffrey Kleintop. You can see him on CNBC. He's on Bloomberg. He does make the rounds and is well thought of as being a strategist in making predictions and portfolio adjustments. One of the things that he did sort of point portfolios towards this year, and we did not follow, was going to 20% cash, 10 to 20% cash. We elected to go more towards bonds to pick up the yield instead of cash, and I think that's probably been beneficial to most of our portfolios. But we're gonna hear his kind of review of the last 6 months and a look forward for the rest of 2012.
Hello, this is Jeffrey Kleintop, Chief Market Strategist for LPL Financial, with our mid-year outlook entitled Campaign 2012, What the Elections Hold for Investors. In the first half of the year, investors focused on the need for capital by European banks. In the second half, all eyes will turn to the U.S. capital and the upcoming elections. Our outlook over the second half of 2012 remains on track based on the predictions we laid out at the end of last year. We continue to believe that the U.S. economy will grow about 2%. The U.S. stock market's likely to post an 8 to 12% gain, backed mainly by earnings growth. And corporate bonds will outperform government bonds as they post modest single-digit gains. In our 2012 outlook, we stated that the party that emerges in control following the November 2012 elections will forge the decisions that will represent one of the biggest shifts in federal budget policy since World War II. In the second half of the year, the elections will become an increasingly potent driver of the markets and determine whether our expectations for the year are on target. The connection between the economy and the election can most clearly be seen through the historical relationship between income growth and election results. Inflation-adjusted after-tax income growth of about 3 to 4% appears to be the threshold for incumbents to get 50% of the popular vote. Above 4%, the incumbent gets reelected. Below 3%, and the challenger wins. Between 3 and 4%, a lot of other factors come into play, making it close. As we start the second half, this measure is at 0.6%, suggesting that President Obama faces an uphill battle for re-election. While other factors may have a bearing on the election, income growth and related job creation may be the key measures by which the presidency will be judged. But no matter which party controls the White House, the changes in Congress may have a dramatic impact on the second half of the year. The election may result in both chambers being controlled by the same party. The Republicans are likely to retain control of the House, but they could also take the Senate. Markets are likely to welcome the prospect for one party, whichever it is, being in control of Congress. A Congress that can act promptly, get bills to a vote on the floor, work on them in conference between the chambers, and bring them swiftly to the president's desk would be a dramatic change to the last year and a half of gridlocked government. After all, Congress writes the laws. A Congress that's able to work together is critical after what happened with last year's debt ceiling debacle and debt downgrade. Congress has the potential to move from gridlocked to unlocked in 2013. And this matters a lot to investors because the 2013 budget is going to have the biggest impact of any budget in decades, even if no action is taken in Washington. The fiscal headwind, composed of tax increases and spending cuts already in the law, total well over $500 billion, or about 3.5% of GDP. The U.S. has never experienced a deficit cut by more than 2% of GDP that didn't end in a recession. In the second half of this year, the markets may begin to move higher as they price in a major budget deal taking place in early 2013 that would restructure these changes to be less of an economic drag. The risk that a deal does not happen and a return to recession may be looming in 2013 should keep markets from posting exceptional gains in 2012. Looking beyond the U.S. and turning our attention to Europe, this has been a major period of global political change. 12 of the 17 Eurozone governments have collapsed or been voted out over the past 2 years. And votes in Germany and Italy are coming in 2013. In the second half of this year, Europe's likely to lay the groundwork toward a further financial integration. But leaders are unlikely to agree on details that would immediately alleviate pressures. And that means the concerns over the fate of some southern European countries may linger and drive volatility. In the second half of 2012, the issues facing policymakers here and abroad are daunting. However, the issues facing investors may not be so dramatic or as prone to disappointment as they may at first seem. Remember that in the first half of the year, Greece defaulted. Spain needed a bailout. Iran thwarted deadlines on their nuclear program. China's economy slowed to the weakest pace since the recovery began 3 years ago. And total U.S. federal debt to GDP crossed over 100%. Yet, the world did not end. A crisis didn't erupt. And U.S. stocks and bonds actually posted gains. We remain committed to our forecasts for gains this year, given our assessment of the developments and their likely impact in the second half of 2012. I hope you found this overview valuable. We've also published a detailed white paper on our outlook and encourage you to review it for further insights. Thank you for your time and for your business.